because I feel like there's no room to over deliver if you're just like saying, oh yeah, we've got $1 trillion of capital in the room. Like it like sounds like hokey on some level and you kind of lose credibility. So I don't know. We try to be a little bit anti that, even though maybe we don't brag enough or do the whole Wolf of Wall Street chest beating.
We're not the operators. So we can zig and zag all we want to. If I was just doing multifamily, it'd probably be tough to go into an office building and you can do it because a lot of the fundamentals are the same, but it's different. For us, we just need to go whichever way we need to with our partners because they're the experts in that area. So we're identifying it from a macro basis.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Welcome everybody to today's Capital Raising Show. This is your host, Tim Mai, and today I have a really awesome guest on the line with us. He is the first one that we have interviewed, that I have interviewed, that have raised over $1 billion for deals. And so it's an amazing gentleman, Mr. DJ Van Keuren. DJ is a co-managing member of the Evergreen Property Partners. He was named one of the top 10 U.S. family office real estate professionals by Family Capitals, and is also named the top 30 real estate investors at the family office at Trusted Insights. DJ has held senior management position in several very prominent single-family offices. Among them are the Hyman family, the Osnolts family office, and and also acting as a president of the real estate for family member of an owner of the Major League Baseball team. So DJ's resume is actually like a mile long of all of his accomplishments and all of the things that he's done. With that, let's give DJ a big welcome, y'all. Woo! Well, DJ, thank you so much for doing this interview with me today. I'm super pumped for this. If you can, let's start out. You can share with everyone, how did you even get into this space of wealth management, especially for family offices?
Yeah, so if I go back, when I graduated undergrad, I was a financial advisor, and I did that to about 2000. I sold that and moved to Vietnam, which we've spoken about before. I was over there and co-founded a coffee company and decided to come back in 2003 and said, what do I want to do? And I said, I always loved real estate. And so I came back, decided to do that, started what was going to be the first single family REIT. Really got into market cycles and actually read everything I could on real estate, and that was from, if you guys remember, I've got a thing, the late night guy down in Florida who, was going over things. I forgot his name for now, all the way to, classes that I had at Harvard. And it was interesting because that, comes full cycle when you in a lot of that stuff. And so got out of grad school and worked for a major developer where we were doing active adult communities. And then moved to New York City, got asked to be part of a small team with one of the largest developers out of Mumbai. So we were buying hotels and condos between 75 and 450 million. And then I moved to Denver and literally fell into the family office space. And that's where I worked for my first billionaire on the real estate portfolio, got headhunted by the Hayman family of Giorgio Perfume, Georgie Beverly Hills, came up with a boutique office brand strategy. We got that stabilized, did some work of one of the owners of a Major League Baseball team. And then I'd been asked from a lot of families to help them on their investments, but I had been employed by various families. So formed Evergreen with a partner of mine. And first family we started doing work with, and we still are, is the Marriott family. And then we've been investing on behalf of families. And then along the way had found the Family Office Real Estate Institute, which very excited about, because a lot of great education, and nobody else is really in that space for families in real estate. And so, similar to what you're doing, providing education, which is one of the key components.
That is awesome. So so the Family Office Institute, so you educate family offices, or you educate high net worth families to start a family office, or both?
Oh, it's strictly on real estate. And so we've got a number of components to that. We have the Family Office Real Estate Magazine, which is a quarterly publication, which is targeted for families. We do podcasts and interviews on videos and podcasts like yourself. We also have consortiums where operators are able to present their deals to families.
I see.
It's all led around the executive education. So we have our classes at the University of Denver. We do them online, and we have professors from Harvard and Wharton and University of Chicago, family office industry experts. And then we have a summit that's coming up for the first time this year. So, and then we do white papers, and we're going to create the Family Office Real Estate Index. And, but it's all educational based and, community based. We do talk about some of the things about families and what's needed to be done on making sure that they set their family office up properly. So we go into all of that, but it's all focused around real estate.
Gotcha. Okay. That's phenomenal. So in terms of your Evergreen Property Partners, can you share with us what your business model is?
Sure. So we're allocators. We invest with operators on the local level. So, and we usually look to take GP positions or GP and LP positions. So, we don't sign for any loans, but we are there to provide equity that we have internally, which come from families primarily. And, we'll invest those into various projects with, people like that are on this show today.
I see. Okay. And what do you look for? What type of properties do you look for? What type of operators do you look for?
Well, everything that we lead with all has to do with due diligence on the operator. So that's the first thing. And I say that all the time with families. It doesn't matter if the deal's any good if you don't have somebody that can execute it. So we start with the operators. We'll look at their track record, obviously. We'll take a look at if they've gone full cycle, if they've been through various, what if they had invested during the recession, and if so, how did they do? If they gave properties back, which is okay, how did they react to it? What did they learn from it? So we'll look at the longevity. Then we'll get into and make sure that they're solid, right? They have a solid balance sheet and can implement. We'll also take a look at who they've invested on behalf of before. Have they invested on behalf of institutions? Have they invested on behalf of friends and families? Who is it that they've invested on behalf for? Usually ask for some referrals. And then we get into the deals itself, and we'll look at, there's certain markets that we like. And we'll see, how long they've been in that market. And then we'll just drill down, if it's a we'll like a multifamily, we'll do a market demand analysis to see what the real demand is there. And so from there, and then it's about a relationship, right? Because it's a partnership. So you got to like each other and get along and understand and what their philosophy is and their values are and stuff like that.
I
Relationship
see.
driven.
Right. That's great. I know a lot of smaller operators, they tend to shy away from institutional money, or maybe they just don't know how to best, source institutional money. In your with your family offices, do you consider yourself as an institutional investor from that perspective?
That's a good question. I would say that we're in the middle of the two.
Okay.
And, my partner had a vertically integrated company, and his investors were American Realty, the eighth largest pension advisor, and Apollo Global Management. And so we know the downsides. I've done work too with Carlisle and Goldman, and so we know what they look for and the difference. And I would say, to answer your question, is that, we try to be a good partner, try to add value when we can, try to utilize our experience to help. And, we're not going to sit there, depending on how much money we put in, we may try to say, look, if we need to step in, we're going to step in. But you should, if that were to happen, you could want to step out anyway, because you're like, well, we're not doing a good job, right? But then our relationships become, our partners' relationships. So we do have somewhat of a oversight, but that comes from meetings and everything. So we're not passive, but we're not all over you like the institutions are.
I see. Okay. And what is your what's your ideal deal size or investments that you would like to deploy into a deal?
Yeah. So we are, and families are along the same line of us, but um really believe in secondary markets, right? Properties between 10 to 45, 50 million total size. So these are anywhere from, equity checks are going to be from 2 to maybe 12 million, right? That's really the sweet spot, because it's underneath the institutional capital where they have to write typically $20 million on equity. And then it's greater than what we call country club money. So you've got to have, where they might be doing their own deal. So it's right in that sweet spot. And from that, you have less players, and you can create the greatest value, or you can pick up properties of from people that weren't necessarily as good as maybe your operators are, right? And so it's people that were dabbling in there, and so you can pick up those properties as well. So it's right in those sweet spots and secondary markets.
I
So
see.
we love the Denvers, the Dallases, Boise's up and coming, Nashville, Charlotte, a lot of the same that I think people target. The only area we really stay out of is California for the most part, because they've got their own challenges as a whole.
Yes. In terms of the amount of money you raise, plus minus $1 billion, I mean, it's such an impressive. Has the bulk of that money been from family offices? I guess my other question is, do you raise money from retail investors at all?
So this is a very good question, and I might answer this in a long-winded answer, if that's okay for you.
Yep.
So, one of the fortunate things that I've done is I've been able to raise money at every single level. And I think it's important that people understand the differences, because I think there's a misconception in a lot of ways. So as an advisor, I was a financial planner, and so it would be retail investors, right? So I understand that space, incredibly. And, the people that it's their own money. They want to make sure that they have it. It's going to be there for the future in retirement. They don't necessarily have the education on all the various types of investment opportunities, which are, everywhere from stocks and bonds to annuities to, alternative assets, right? And that includes oil and gas and real estate, et cetera, right? So they really rely on the advisors for the most part. So it's really about educating the advisors to get to the retail advisors, or educating those retail investors. Now, those are passive, 100% passive. They're going to be like, send me the check in the mail or keep me updated about, how things are going. And it's all based upon the story. It's all, do they get the story? Do they understand the story? Is it simple? Does it make sense? And that's really what retail investors, invest off of. So very passive. The second area I would say would be the registered investment advisor. You can get to work with them. They're usually independent. They don't have to worry about the securities laws in the same way that a broker dealer does, right? That's working directly with those investors. And they usually have access to a lot of clients' money. And if they're just charging a fee off assets, they're really looking at the deal and they're not getting compensated on a commission basis, right? Once again, that's relationship based, but you're getting bigger pocketbooks. The third type I would say is, well, the institution is at the end of the scale, but institutional capital, usually there's MBAs that are, just got out of grad school, 30, 31, 32. You have to remember whether it's insurance coming from insurance monies, insurance companies, endowments, foundations, or from private equity funds. It is not their money. They have zero relationship to it. They're very analytical and they have a bot. So they will literally say, okay, we are looking for multifamily. This, this is how much we put out. These are the markets that we look for. They're very specific and they're very easy to find. So when anybody goes to the into the institutional marketplace, you can literally Google, and sometimes you'll be able to find the forms that say, this is what we invest in, this is what we look for. If you buy a list of institutions, they will be legit. You will get legitimate names and contacts from there. So the private equity funds, what you really have from there is a box to invest into. And it's very important to understand that they have zero emotions to that money. Right. Incidentally, a great place to go that a lot of people don't go if somebody's wanting to get into that marketplace is going to be the smaller endowments, the smaller universities, because they're only going to write $5-10 million checks, and these big private equity firms, they want $50 million commitments, $100 million commitments. And so those smaller endowments and foundations are a great place to go, and they don't get called in all the time. The other thing too is that, the retail investors are getting suggestions from their advisors, or they're doing it themselves so they can make a decision right away. On the institutional side, they'll go to committees and they're going to have to vote on it and really review all of the various components to it and dive really, really deep. And they're going to look for controls, which is why a lot of people want to go without that. The good thing is, like I said, is that you can reach them. They'll take your phone calls. You tell them what they're doing, and there's a certain way you should package those deals, because if when I would pack it for an institution, literally, I would send a package about this thick of everything. So I would preempt them because I know what they're going to ask for. If anybody wants to get an idea of what kind of things, I'm happy to, share that with whomever. And then the last is family offices. And there's a very misnomer about families. Everybody thinks that they're going to write a $5, $10, $20 million checks. Could it happen? Yeah, it could happen. Probably not. It's very, very relationship driven. And they might, if they start, they might write a check for 250,000 or 2 million, but the next check could be 2 million or 10 million, right? So it's, do I trust you, first off? So there's a big component of trust. Two, once they are happy, they will refer you to other families once you get in there. I think there's two biggest things that people need to understand about families, or a number of things. One is that it's relationship based, right? Which everything is, but it's very relationship based. Education still applies for everything, providing them updates and insight and whatnot. But you have to remember that these people created their wealth, and our definition is 250 million or more of what a family is. Richard Wilson, who you know and whatnot, you know, he might say differently. He might say, you know, 20 million to 150 million, you can be a family, right? And so that all varies, and it's really depending on what you're trying to accomplish. But these are people that spent 40 years in a one specific area. It could have been chemicals. They could have created these tires. It could have been switches for the, you know, for the street lights, right? And so when they get this amount of money, which is significant, and it could be, you know, 200 million plus billions, even 50 million, even if somebody got 15 million, don't forget they've spent their whole life in that area. You ask them about chemicals, they are going to rip it off to you right away. If you say, well, is this good? They're going to go into massive details, but they don't understand hedge funds and venture capital, private equity, real estate. And then when you get into venture capital, some people focus, let's say, in healthcare, and not just healthcare, but also, you know, mid-market, right? So so that's one thing you need to understand, which goes back to, don't assume they understand. You go to the institution, they're going to understand it inside and out. They're going to understand the market, the characteristics, cap rates, all this stuff. Families like retail investors, and that's really what they're more like. They're like that retail investor because they're not going to have that money again. Most likely, if they do, it's very rare they're going to create another, you know, hundreds of millions of dollars. It's their personal money. So there's emotions involved. So retail investors are very much like family offices, where it's their money. They need to understand. So it comes back to a story, and you need to educate them, right? So if you're doing workforce housing, you don't just say, okay, so we have this deal in, you know, Dallas, and we're doing 300 units, you know, and your return's going to be, you know, 20%. You have to take into consideration, say, look, we're doing workforce housing, and you might already know this, but let me explain what workforce housing is. And you need to explain that. I've had families before that ask me, what's workforce and what's the difference between low income and workforce and market rate and stuff. So if you start at that, and one of the best examples that I can give you for anybody here, if you're trying to raise money, even if it's retail or it's RIAs or families, is to say, we're focused on workforce. Now, workforce is this. Here are the characteristics of workforce. These are the types of locations that we look for. For example, we're working on this project at 123 State Street. And then you relay it back to say, so when we were saying we're looking for these income levels, that's exactly where our deal is falling into. And it's this kind of neighborhood, and this is exactly what we're doing, you know? And if you're doing a rehab, you can say, look, it's no different than you go and you buy a house that you have to fix up. We're just doing that in 100 units, right? Which allows us to increase the rents, which increases the value. So, you know, I think the more you don't assume, because if people don't understand workforce, you're going to lose them right there, possibly. And so, you know, those are the various channels. And so having a good understanding, and once again, it always comes back to the story.
Gotcha. Yeah, that's great. What would you say might be some of the challenges when it comes to approaching these, whether it's the family offices or the smaller endowments, you know, this, I guess, $1 million to $5 million check writer type? What are some of the challenges we should be aware of in targeting that, you know, that type of an investor?
Time. So if you are looking to raise money in 30 days, it's not realistic. So you know, a typical fund on average takes 18 to 24 months to raise a fund. I mean, that's just what it is if you look on an average across the board. And so And a lot of that has to do with understanding who you are, getting to know them, building the relationships, right? Keeping them informed. Now, how you can get around that is you get to know them, you educate them on the type of deals. Hey, when we have something, do you want to take a look at it? And so it's just time and building that database and then staying in front of them in some degree. So, I say that's a challenge because we all get busy. We all get caught up in doing different things. We know we should be communicating, staying in touch. And so sometimes it's difficult to do that. And you should be seeing your investors or potential investors as much as you can. There's nothing like face to face. And so it's it's a time management issue more than anything. I think that's one of the biggest challenge. And then as you get busier as an operator, right, then you start focusing over there, and you got to remember you still got to lock into getting those monies, communicating with those. So I think that's probably balancing all of that. But remembering that, hey, I got to continue to build my pipeline.
Gotcha.
Continue to prospect. And it's easy to say, it's not always easy to do.
That's that is definitely important. So let's say, I buy this list of family offices of these endowments. Do you have some tips on how can us smaller operators reach out to these people in a way that get them to remember us, get them to consider doing business, like something that's not normal, that perhaps they're getting bombarded from other operators?
Well, I will tell you that the solution so you're saying basically how do we outshine other people, so when they think of me first before somebody else?
Yeah,
right?
something like that.
Almost.
Yeah, like perhaps you have some some tips around how to best do that. Yes.
Okay, so what I'm gonna tell you, I think I said this when I spoke at your event, and people are gonna laugh probably when I say this, but in order to be on top of mind, you need to do everything you need to do that you're not doing. And the best person and material that I've come across raising money from families is Richard Wilson. And if you get his book on capital raising, which is very small, it goes on over all that fundamental information, which is keep in touch, right? So that is everything from sending emails, making phone calls with them, keeping them updated. If you mail something in the mail, nobody gets anything in the mail anymore, really. And maybe it's just a postcard, where they're seeing your name. If you're doing podcasts and you're just saying, hey, I just was on an interview like this, or maybe you want to interview somebody, write articles, and you take those articles, you send them to them to say, hey, I was just quoted, or I just wrote this article that I sent out. You can repurpose those too. And so it's all the various elements that, like I said, remains to be on top of mind. And you do a good job of keeping in front of people, right? One way or another, I'll see you up on LinkedIn, there'll be emails, there'll be different things. Same with Richard, he's always has something posting, or I'll get stuff in the mail from him, and everything. So that's the best way to stay on top of mind. Do the things that nobody else is doing, which are fundamental and people know that they should be doing. And then when you do get a list of family offices, they're usually not that good. So unfortunately, you're going to have to go through and identify which ones are real and which aren't. And that's just in general of marketing to buying any list. The only exception I would say would probably be institution lists, because it's public knowledge. And so you could build a list of 5,000 easily for that. You don't want to take the time. So you can buy that. Families are hard to find.
I see.
And so that would be the biggest thing. And then when you do contact these families, ask them to say, hey, what type of properties are you investing into? Can I keep in touch? If I have something that might be of interest, can I share that with you? And it's as easy as that.
I see. Okay. What about the small endowments you mentioned earlier? Are those lists, are they included in the institutional list, or are there a
And you
separate
can
list for
get
that?
you can get lists for those smaller endowments. You can. They don't get called on as much. Now they do typically have a community or a committee
Mhm.
which will talk about things, but it's much more streamlined. It's people that are, and they because they don't have a lot of money, they'll make smaller checks. But if you are able to get in one of those, but once again, it's a time issue. You got to realize that you could get a check in 30 days, you might not get a check in 3 years. It's
Mhm.
about building that relationship pipeline
Mhm.
more than anything.
I see. Okay. How do we know that certain families or small endowments, like, they have a need to invest that money? Are they ever in that situation where it's like, okay, you know how, like, with a 1031, for example, where they need to turn around and invest quickly? Are this those kind of situation where we are able to find them at the right time when they really do need that, to deploy money? Maybe it's within seasons or something to that nature.
And this is specifically on families that you're asking from
Yeah, it
that
could be.
perspective.
Yeah, yes,
Okay.
correct.
Okay, so there's a couple of things. One is that we're starting our 5th year of the largest family office real estate study actually in the world. So happy to share that with anybody. And so we're starting to see trends. 80% of families don't do 1031 exchanges, which
Mm,
is ridiculous. And that's been consistent over the years. There's a couple of reasons. One is primarily education. The When you're looking at families for money in motion, it's either going to be 1031 money, just like everybody else, or OZ capital,
mm,
because they need to get it in a certain period of time, right? And so if somebody's selling a business and they don't want to pay taxes, there's a great opportunity. So those are the two money in motion. I'll tell you about investing in real estate. So 90% of families, and we're saying 250 million or more is mine. So it is, and there's about 17,000 of those globally, of which 76,000 are here in the US. If you expand that out to people, and somebody told me years ago that, like, in Houston, there was 1,500 people that were worth 100 million, right? Yeah, that's a fair amount of money, right? So, um, so when you look at families, 70% of families lose their wealth by the first generation. 90% lose it by the third
mm,
generation. All right. And this is real.
mm,
I'll give you an example. I was in my office one day and a guy comes in that I knew that was with a family, said, "Hey, how you doing?" And he goes, "Oh, not good." And I said, "Why?" And he goes, "Well, I just lost 80% of the family's money because I was trying to work on this real estate project in New Jersey, etc." And I said, "Really? How much was that?" He goes, "Yeah, 800 million." I
wow.
mean, this stuff really happens. So
Wow.
the average allocation is about 24.5% from a family. Their total portfolio return on average is 7%.
Mm,
It's not as much you'd think, but that's because, every time I work for a family, they said, "DJ, you have 3 rules. Don't lose money, don't lose money, don't lose money." Right?
mhm,
So I am the biggest believer that you say, families needing money, wealthy people, they need you, because real estate is the best place to maintain a legacy and create additional generational wealth. And it's a hard asset. You can't just liquidate it tomorrow, right?
right.
It can give you cash flow. It has all the tax benefits, everything. And so 100%, real estate is, I'm a preacher when it comes to real estate. So I think that the money in motion is 1031s or OZs. The rest is, you know, how are you allocating? 70% of families want to go direct. Of, however, for those that are doing funds, we had a study done by one of our board members, Joe Pagliera. He's the head of real estate at University of Chicago. To an optimized portfolio that decreases a risk is 15 properties. And so, families really need to be diversifying, and people in general, anybody needs to diversify to mitigate some of that risk. So, once again, it goes back to the relationship. And then when they have an opportunity, it's going to vary in timing from when people have money to reinvest.
Right. Okay. Michael has a question here on the chat that I think is very appropriate. Have you ever had a capital call, and how does that, if you have one, how does that go over with family offices?
Not a problem. Not a problem at all. We've had friends, families, people that got referred in where they wrote smaller checks, right? They might have wrote 100, 200,000 or whatever. My experience from anybody that's going to write a check, whether it's 25,000, 50,000, 100,000, is you better get that money up front. Because if they don't have an abundance and you're like, okay, give me 25,000 a day, and then I'll call another 25,000 in 6 months, guess what? That money's probably spent or invested somewhere else. So you need to take that right away. When a family is able to invest, $500,000, 3 million, 10 million, capital calls are not an issue. They're used to it. They understand it. And so it's not a problem whatsoever. What we'll do sometimes is we'll say, and this varies of how you have structured a deal, because if you're doing a preferred return, you're going to kill your returns. If you structure something as an IRR, or let's say 7% instead of a 7% preferred return, you can give people an option. Do you want to call down, or do you want to bring it in? But the bigger families, they're going to probably expect that anyway.
Okay, interesting, very interesting. In terms of I guess we'll explore further in around family offices here, but what are some of the, I guess, other ways besides buying lists for us to be able to find these family offices, like source these?
So one is to get in touch with RIAs, registered investment advisors, because in multifamily offices, because they may have, you look at a BMO family office, they're about a $30 billion family office, because they do a holistic component for their families. And usually an advisor has 10 to 12 families that they'll manage. And these people could be worth anywhere from, 100 million to $1 billion. So that's one way. RIAs, and there's some great databases for RIAs. One is called actually RIA database, where you can actually slice out, okay, this is how much they manage. So if you're like, I just want to talk to RIAs that have $1 billion in asset under management that they're making decisions for on behalf of their clients, or showing them opportunities, once again, they could have 5, 30, 50 different investors that are worth a sizable amount. So that's the first way I would say, is to go through these RIAs. And if that RIA likes what you're doing and they like your opportunities, then they're going to be a cheerleader for you, which is great. So in that situation, who you want to take care of is that RIA, and build that relationship with them, because he has that relationship with the families. So that's one of the quickest ways, is multifamily offices or RIAs. Outside of that, it really comes down to referrals. I mean, if you can get, let's say you buy a list and you identify 4 or 5 families, you get to know them and ask them if they have referrals. I mean, there's no really simple way to identify families,
Right.
as much. One of the reasons I started the magazine was to gather names and families. That was a lead generation tool, and it still is today. So there's specific questions I'll ask, and I'll know right away if they're a real family or not, and how they are. So that was what I did. And that's, the same way you generate leads for retail clients, right? It's just that you're in a different type of a marketplace.
Right. With this market, I mean, you've been around for a long time. Where do you see this market going, and how are you positioning yourself to, take advantage of this market? So two-part questions.
Yeah. So, I see this market that a couple ways. One is that I don't see us going into a recession until, and I've been saying this for years, probably 27, 28. So I don't really see that coming about for quite some period of time. However, with the rise in interest rates, what's happened, especially in the multifamily side, is that if somebody buys at a 5 cap and they have to get a loan at a 6.5 cap, you have negative leverage and you have problems.
Hmm.
There's a lot of smart people that say that we're about to see a ton of debt that's going to be that are going to become available to buy. So people that are, if you're holding off a little bit on some multifamily stuff, I would wait to see if you could even buy some notes because of and buy the debt. Then you go in the first position. You can take it over. You have the experience as an operator to do that. So I think we are definitely going to see some fallout in a number of property types. And so there's going to be an opportunity there. Interest rates, if you historically look, they could technically go up to 9%. So, what we've focused on is opportunities where there's a significant demand, where we can buy at higher cap rates. And so we've just really narrowed our focus for what we do, because remember, we're not the operators. So we can zig and zag all we want to. If I was just doing multifamily, it'd probably be tough to go into an office building, and you can do it because a lot of the fundamentals are the same, but it's different for us. We just need to go whichever way we need to with our partners because they're the experts in that area. So we're identifying it from a macro basis.
That's really awesome. That's good. Wakefield has a question here. Can you talk a bit about how you started working with your first family office? What worked well and pitfalls to avoid? What was their process of vetting you? So
95% of the people that work for a family office fell into it, just like myself. And how the other 95 fall into it is because somebody has an exit, they have all this money, and they're literally like, okay, who do I trust? So it could be their accountant, it could be their banker, it could be their advisor, it could be their neighbor, who successfully ran businesses. And that's important as well, because let's not forget that principal, that patriarch or matriarch that spent their whole life in one area, they don't understand all the different investment components. Neither does that CIO, because they're coming in and they're like, I got to figure this out, right? But they can trust them. So that's usually what happens. And so that's exactly what happened with me. I moved to Colorado, and I literally, after about a year, I hadn't met anybody locally. So I sent out an email just introducing myself, and I literally sent it to a list of developers and real estate companies in Colorado. And I said, hey, I gave them my background and my education, and I just love to meet you at some point in time. And people were replying, sure, come on over for a cup of coffee. And they're like, we're not hiring or anything, but I'm happy to meet you. And then I got contacted by a guy that was the president of a family office, and he said, hey, why don't you come in? So we're just talking, and he had invested all his money. He sold his company for $1.5 million. He just signed the $1 billion pledge last year, and he's done that all in real estate, and it's been his own money. And so they were in the process of starting a fund to raise money. And they asked me, DJ, where do you think we should do? I want you to come back to me and give me an idea of where to raise money. And I knew they showed me who they were contacting on the institutions. And I was like, I know 50% of these people because all of my stuff I was doing was institutional wise. And I'm like, well, I know all these people. I only knew 2 families. And I looked at it and I said, okay, well, I know all these institutions. We can go out there. But he's really a family because he's writing his personal checks for everything. And I said, go to family office route. And I didn't know anybody. And about a year later, I knew about 200 families. And so I just, I put my head down and started meeting a ton of families. And that's how I literally fell into it. They said, okay, let's do it. And that's how it began. And then, off we went.
That's phenomenal. It's a great story. So, this whole thing of family office is very new to me. I've only learned about recently. I come from, a very modest background. When I moved here to America with my older brother, the 2 of us, we were living in Section 8 housing. So like, to have that kind of wealth, to have a family office is like something foreign to me previously to getting into this the commercial real estate industry. I'd love to hear from you. What are some of the things that that perhaps or that you've learned about wealth that the common people don't know or not familiar with? Give us some of that, whether it's mindset or perspectives, or of what it takes to grow that kind of wealth.
So basically, there are a bunch of things that I've learned. The biggest thing that I've learned from families and patriarchs that I've worked with is they will surround themselves with smart people, but at the end of the day, they will make a decision themselves. So they'll gather the data, and if they all said you need to go right, and he feels he needs to go left, and he believes that, he goes left. He bets on himself before anybody. And they're like, look, I'm controlling this thing. This is me, and when they make a move, they make a move. And if they make a mistake, they learn from that mistake. So that's the first thing. The second thing is they always look to protect their downside. What's the worst thing that can happen here? How can we protect it? Make sure that there's not, that we lose money. They're very conservative once they get the funds. And, we're just talking strictly on the investment side. However, where real wealthy people have problems is more on the family side. I mean, all of us and many people will get in fights with other family members. It could be anywhere from their uncle, their aunt, to their brothers or sisters. And you have that tension, right? I mean, I have some of that right now with one of my sisters. Now add $100 million, $200 million to that. If anybody hasn't watched Succession, watch that show, because it really gives you an idea of some of the family dynamics. And you have people that when people get money and they get it passed down to them, just like lottery winners, they didn't know how to make the money. So they can lose it very quick. Sometimes it goes up their nose, it all varies. But I think the biggest thing is dealing with all this money. The investing part is really the easy part in my mind. It's the dynamics, the family dynamics, and the planning, and making sure that you can continue and maintain your legacy. I think that's the biggest thing. But like I said, it goes back to, and some patriarchs, they leave their business and they were controlling everything and they don't get their family involved. Well, that can create another problem too, right? But the people that's made their money, they bet on themselves.
That's awesome. We're going to be wrapping up this segment of today's interview. Before we do that, thank you so much for like sharing so generous with us today on this interview. How can the audience support you or contribute to you? What are you looking for?
There's two sides of the coins that we're doing. One is, we're about to roll out a real estate fund that I've been constructing for about 6 years now that does not exist in the market. It will disrupt the market. When we do that and money starts coming in, we need to look for operators that we can allocate to. So one is deal flow, right? Is one of them. And like any investor, the ideal investment is one that's programmatic, where you can continue to build that relationship and invest, right?
Right.
So that's one. And then we continue to build out our relationships on the capital side, which is what everybody else is doing here as well. So I think the biggest thing is that when there's opportunities, then let us know about it. We'll try to respond right away. Some of it might not be, could be a timing issue if we're not focusing there, but it's important that we maintain the deal flow coming in so we can look. And, I'm happy, and I say this all the time, if there's anything I can ever do or people have questions and stuff like that, feel free to send me an email or whatnot, and I'll do what I can.
That's right. That's a perfect segment into my next question, which is, how do you how can the folks listening in reach out to you, connect with you, invest with you, potentially source you deals? Where would you like to send them?
Well, if they want more information about myself, they can go to djvankeuren.com. That gives you a little bit of information. I think there's an email on there, and then my evergreen email is dj@evergreenpropertypartners.com. So, if they want to find more about me, they go there. If they, and if there's any investors that are listening, I wrote a book called the Family Office Guide to Investing in Real Estate, and I'm happy to send that to whomever if they want to, shoot me an email. Once again, it's dj@Evergreen Property Partners. It's a pretty fundamental book, but I think it's pretty valuable from that perspective too.
That's great. Thank you so much, DJ.